With commodities at all-time highs, what is this bull trend signaling in terms of economic growth, inflation expectations, and how should investors be positioned for this changing macroeconomic landscape for the second half of 2025? Brett Heath joins us today. He is the CEO of Metalla Royalty and Streaming. Brett, welcome back to the show. Good to see you again. Thank you for being here.
Thanks, David. Thanks for having me.
Gold, copper are reactive to market sentiment around inflation as well as economic growth. Copper is called Dr. Copper, and gold has been a good barometer for inflation expectations. Do you think gold at $3,300, touching $3,500 earlier this month, do you think that signals a return of inflation, or at least investors expecting inflation to come back at some point this year, perhaps next year?
Yeah, I think it does. I think it does because gold typically, if you look at kind of gold moves always in advance. And so when you see these big moves, you typically have inflation that kind of comes behind it. It always tends to run in advance of different types of events and so forth. So, I think that central banks generally see this. And what we've seen is gold purchases already exceed 1,000 tons per year for the third consecutive year. We see gold now comprises approximately about 20% of global FX reserves. So overtaking the euro as the second largest behind the US dollar. Ultimately, we could see that rise probably as much as 50%. And whether that's central banks coming in and buying more gold or the gold price kind of rising. I think that it's in a very, very strong kind of, again, longer term structural kind of shift in what that looks like. But generally, all these central banks are buying because they see the devaluation occurring across kind of a number of different fiat currencies, and I think that they're acting in anticipation of inflation and probably other things as well.
This is a chart of the DXY. I'm going to overlay this with gold. As you can see, that's not a very good chart. Let me do different y-axis. There we go. Inverse correlation between the dollar and gold, quite normal, as we can, throughout history, except for a few exceptions, gold has usually acted as an anti-dollar asset, moving in the inverse direction as the dollar. So this year, dollar weakness was the main theme. I'm going to get your dollar outlook. A lot of people on my show have been commenting on the kind of collapse of the fiat currency and how to hedge against that. But are you surprised, first and foremost, that the dollar has been weakening versus other currencies, which is why the DXY shows this year, while tariffs have been announced? I mean, typically, wouldn't you expect the dollar to strengthen when other countries were being tariffed?
Yeah, and it's interesting to see it behave this way because it is not something that is kind of a normal reaction when you look back historically. But I think it goes to show that the trend is kind of continuing on. Like you see, central banks are actively diversifying away from U.S. Treasuries to reduce the credit and the currency risk exposure. The World Gold Council recently did a poll amongst all central banks and in asking them if they're going to be increasing their gold reserves next year. 95% said yes. And so, what we're seeing right now is we're seeing, gold basically becoming a reserve asset. Well, what is the reserve asset of the world today? Well, it's US dollars, and it's still significantly US dollar weighted, across most central banks' reserves and just the way the world operates. And so, we're going to kind of, I think, continue to see this trend in motion here for the next couple of years. And I think that is going to continue to put more pressure. Now, obviously, nothing will go kind of straight down, and there'll be certain probably events that increase the dollar's kind of position within global markets. But generally, we see that breaking down and probably what is the beginning of a much longer term downward trend.
How significant could this dollar downward trend be? I mean, we're looking at, the dollar's not going to collapse tomorrow, but what does this mean for the average person? What does this mean for the average investor?
Well, from a US dollar perspective, generally amongst everyone that uses and lives within the United States, it means a much lower standard of living. Because as the US dollar decreases against other currencies, primarily the currencies that you see positioned and kind of breaking out on the other side while the US dollar is breaking down are more commodity linked currencies. So you see the Canadian dollar looking like it's in position to do a little bit better. You see, Brazil, other kind of brick type of countries, currencies looking like they're starting to do well. Um, so yeah, so what that means is basically as those currencies appreciate against the US dollar, it's generally kind of going to be more expensive for people that live in the US or use US dollars as kind of a main conduit of buying and selling goods. It's going to be more expensive.
On the central bank buying of gold, this is from Reuters, quoting Metals Focus. Central banks are on track for a fourth year of massive gold purchases. Central banks worldwide are on track to buy 1,000 metric tons of gold in 2025, which would be their fourth year of massive purchases as they diversify reserves from dollar-denominated assets. Tell us about this trend. Why has this been happening over the last 4 years?
Yeah, I mean, it's interesting because this has been a trend, as you noted. It's been going on for quite some time. And again, like I think that it's a changed, it's starting to evolve a bit. And I think, if you really think about kind of where it's evolving, I think it started at a place of, well, we just have way too much exposure to US dollars, to US treasuries, and it was just completely lopsided. And it was a sensible thing to start to kind of reduce that exposure, not a lot, but just a little bit. I think the change today is the view is the US dollar and really kind of the US treasuries that are behind that are not really viewed from a risk perspective the same way they once were. And when you look at how U.S. Treasuries have behaved specifically in 2025, they're not behaving the same ways that they used to. Um, and and so I think that kind of the view here today is that it is a bit more of a risk asset. And I think that all these central banks are kind of looking around and they're saying, well, where does this sit within that risk curve, and where is that comfort level? And as that momentum builds, you're going to see kind of more and more buying of physical metal as a means to, again, increase the global FX reserves to where I think will probably be, the target that I have, I think is ultimately around 50%.
What does that mean for the price of gold once we get to that level?
Well, what does it mean for the price of gold once it gets to that level? It will likely means it's going to be a lot higher than where it is today. It likely means it's going to play a much more kind of, call it, more impactful role in regards to reserves and eventually some monetary role, on however everything shakes out. It's too early to tell what that looks like today. But I think that when you look around the world, gold is seen increasingly as a more neutral store of value, free of all the counterparty risk and political influence, and immune to the monetary dilution that we're seeing, and most recently with the big beautiful bill, on top of all of the debt that's currently being refinanced. I think that the U.S. government right now is about a little less than halfway through with refinancing a big slug of the existing debt. I think they had about, in total, over about 3 year period, it was around $17 trillion that had to be refinanced. I think they're through, around 7, 8 of that trillion, and the balance of that's going to be refinanced over the next about 24 months. And most of that debt is being refinanced from about 50 basis points or less to foreign change. So very, very significant jumps up in regards to the interest expense. This is going to continue to compound on top of the additional deficits or expected deficits over the next 10 years that were just announced. So again, if you're another central bank and you're holding a lot of these U.S. Treasuries and you're looking at this financial situation, it's a very sensible thing to do to increase those reserves towards gold that don't have those typical risks that you're seeing now that never really existed 2, 3, 4 years ago.
Here's the thing. So the CBO is estimating that the One Big Beautiful Bill is going to add to roughly add to the deficit roughly $3 trillion of debt and $2.4 trillion to primary deficits over 10 years. Now, that's just to add to what you were saying. We could look at this in one of two ways. One, inflation is going to return because of massive stimulus from the fiscal side, which would be good for the commodities complex. But on the other hand, this might be stimulative for the overall economy as well. Perhaps that might be good for equities markets. That may put downward pressure on safe haven assets as people rush into riskier risk-on assets and smaller cap stocks, tech sector perhaps, which would not be great for the metals. Are those counter forces, or do they kind of work in tandem here in this particular case?
Yeah, it's tough to say exactly how that transpires through the equity markets. I think generally what you can say is that we're likely to see a significant amount of inflation in the future, and likely equities are going to protect to some degree on that. I would say that when you look at kind of the capital flows and the relative performance, the old guard is not performing as well as a lot of the commodity focused companies, particularly in gold, but other commodities as well. And so I think that is going to continue. Also, emerging markets seem to be kind of turning the corner and relatively outperforming the U.S. market. So it seems that there has been a bit of a structural shift. And my guess is that if we do see a significant amount of inflation, we do see some of these capital flows move into equities. It's likely going to be those places that kind of outperform probably what worked so well over the last 10, 15 years.
Here is the CME Fed Watch tool talking about monetary policy in response. The Fed's been waiting for inflation data to come back. They've been on a wait and see data dependency strategy. Now, the inflation rate, headline CPI inflation rate, has come down from 3% to 2.4%. So it's been sliding all year, but the Fed's still waiting. And the market's predicting no cut by July. Probably one cut by September. Probably another cut by October, although that probability is even smaller. And the Fed's just waiting. I mean, if they cut, it means that inflation is probably not coming back by that time. So what are your expectations for Fed monetary policy this year?
Yeah, well, it looks to me that it's a bit politically influenced at this stage. I mean, I would just try to tune out the noise, like follow the 2 year. If you look at where the 2 year is at today, it's around kind of give or take about 50 basis points less than where the Fed funds rate is today, and it typically will follow that. I would say if you see the 2 year make any kind of further downward movements, then you're probably much higher probability of a cut. But right now, the 2 year, I would say it's forecasting about 50 bips of cuts at some point in the next kind of 12 months.
Brett, tell us about the mining sector at 3,000 gold, 3,300 gold, 3,400 gold. Copper as well, breaking new highs, not seen in the last couple of years. I mean, what is the industry doing differently now that metal prices are at unprecedented levels? Are we seeing more M&A? Are we seeing companies now using this opportunity to raise more money? Are we seeing a lot more drilling activity? How has the attitude from governments been around this? Have we seen permitting times decrease? Basically, is the industry changing at all now that prices have changed a lot?
Well, I would say that the industry generally has done a reasonable job of probably learning from its previous mistakes and not doing crazy M&A transactions and doing things that would kind of materially impact these, call it record margins that the industry is experiencing. We have seen costs increase over the last year. Like I think costs will probably continue to creep up, but most most mining companies that are in the, call it, bottom half of the cost production curve are still netting, if not at least over $1,000 per ounce. So this is a lot of free cash that these companies are starting to kick off, and they got to figure out what to do with it because the industry as a whole has not invested in the future for kind of the better part of almost 2 decades. And so how do they replace reserves that they mine? Well, they're going to have to buy other businesses. So, we're seeing that within the mining sector. We're starting to kind of see that within the royalty sector, which is very interesting. It's been kind of, I think, a long time coming from that perspective. And I think that'll continue because that's going to be the most logical path within the industry to be able to kind of continue to sustain itself.
This is your stock. Congrats on a fantastic year. Metalla royalty is up more than 50% year to date. 60%. Yeah, close to 60% year to date as of the 14th of July, if you count from the beginning of January. Importantly, it's outperformed gold, it's outperformed copper, and pretty much all the underlying metals in which your company tracks because you have a portfolio of different projects around the world. Now, first of all, before we talk about the metals themselves, why do you think this year is the year that capital was starting to flow back or has already been flowing back into the equities? Your company is just one of many examples.
Yeah, David. Well, it's been a very interesting bull market because we saw gold move, and we saw a lot of the equities really not participate for a number of I'll come almost the better part of coming up on 2 years, and I think what has happened recently is that we see a bit of a shift change within the market and kind of how they're looking at this move in gold. I think generally kind of the first part of the move from gold going from 2000 to kind of upwards to 3000, the market's still focused as gold as a hedge. And, a hedge, whether it's geopolitical or monetary or other means, it viewed it as more of a hedge. And I think what has changed, particularly what's changed over the last few months, is now, it looks to me that the gold is kind of looking, or the market is looking at gold as more of a monetary anchor. And we have a bit of a structural revaluation that I think we're just right in the middle of right now. And as the market has changed that view, I think they're taking a different look, or they're really looking at some of these equities in a different fashion.
Has the mining sector, including your company, done anything differently this year to attract investor capital?
Well, I mean, the sector as a whole, I think, is continued to work towards kind of controlling costs. Obviously, this has been very, very difficult with the amount of inflation that's happened over the last 5 years. I mean, you look at kind of any new mine that's been built, there typically has been significant cost overruns and so forth. But there are a handful of businesses in the mining sector that have done very well. Particularly some of the big ones that have performed extraordinarily well over the last kind of year and a half of this bull market. But what we see now is a little bit different. We see, for the first time in almost about 5 years, we're seeing the smaller companies, the kind of the GDXJ outperform the GDX. We're seeing a number of kind of anecdotal pieces of data that show the juniors are starting to move. This also is coinciding with silver starting to outperform gold, which is typically kind of correlated with the move with some of the mining companies as well. So I think generally, as gold has surpassed now 3,000, it's kind of held in this position, and we clearly have seen a structural shift with central bank behavior and how they're looking at gold, and I think this is really adding to where we're seeing these capital flows. We're seeing a lot more kind of come into it in regards to financings, juniors, and so forth.
If you look around the royalties that you hold around the world, right? You've got one in Africa here. You've got a few in South America, North America. What is your message for investors who want to know the primary differences between investing in South America, North America, and perhaps even Western Africa? Some of the key differences in jurisdictional risk and opportunities, grade, and perhaps even risk premiums that they should be aware of when buying stocks from those areas?
So we built our business around tier one jurisdictions. When you look at kind of from a NAV perspective, basically 100% of it is north south in Australia. I mean, a very small is outside of that.
Hmm.
And that was designed specifically because when we kind of looked around the world and we saw that we were going into more of a geopolitical type of volatility environment, and it's absolutely critical when you're owning royalty specifically to be able to have time. I mean, one of the ways that investors make the most money on royalties is capturing the optionality. I mean, the optionality is when you go and buy a royalty like we did on Côte Gosselin, for example. We bought a 1.35% royalty on this mine pre-resource that covers Gosselin, and within four and a half years, that deposit grew from basically pre-resource to 7.4 million ounces. So very significant jumps. And in order to capture that, you have to have time. And the time is necessary to capture that optionality. And that's how we've looked at our business. So we've focused on these good jurisdictions. We've focused on assets that have been in these proven geological trends that are being advanced by these bigger companies, and making sure that our shareholders and our investors have the ability to capture this optionality, which does take time.
Tell us about some recent important transactions in the gold sector. So here's one that we talked about offline: Royal Gold to acquire Canada Sandstorm Gold for $3.5 billion. Royal Gold said on Monday it will acquire Canadian peer Sandstorm. This was last week. Sandstorm Gold for about $3.5 billion. Shares rose from Sandstorm 6.4%, while Royal Gold stock was down 7.6% in afternoon trading. Royal Gold companies generate revenue by collecting a percentage of production of metal from operating operations in exchange for upfront payments or investments. Comment on the scale, first and foremost, of this acquisition for the royalty space. I understand it's one of the biggest, and why it's happening now.
Yes, you're right. So this is the biggest royalty and streaming merger to have been announced ever. And what we're witnessing in the royalty sector is really a symptom of the significant increase in scale. I believe the majors, mid tiers to an extent as well, but mainly the majors have had over the last year. I mean, we've seen just between the three big companies, Franco, Wheaton, and Royal, their market cap has increased approximately about $30 billion since January of 2024 combined. And their revenues for 2025 are expected to reach combined on a combined basis over $4 billion are estimated by analysts this year. So it becomes a question of, what potential transaction can make a material impact on their business, and the relative outperformance of the majors over kind of the first part of this bull market versus the mid tiers and the juniors is now reversing. And so I think it's been a bit of a catalyst in the recent news of the Sandstorm and Royal merger is just a part of that. But ultimately, we see high potential for further consolidation within the mid tiers, and kind of mid tiers and majors specifically. And ultimately, this is great news for a business like Metalla, as we expect to see a significant amount of capital reallocation to the juniors, and also a massive gap in market cap, which I think is going to provide really a very clear path for a business like ours to be able to continue to scale into a leading mid tier in the future.
So what is Metalla's plan to add shareholder value? Like I mentioned earlier, it's already up. The stock's already up 62% year to date. How do we add another 62% from here?
Well, we've got growing royalty production. So we've got an organic pipeline of assets that are bought and paid for that we expect to generate a compound annual growth rate. So this is a compound annual growth rate in production growth between now and the end of the decade, somewhere between 30 and 35%. So all this is bought and paid for. And most of these assets that we bought, we locked in and we modeled these assets when gold was between like 12 and $1,800. So, at the time, when we were building our business in the early years, I don't think it was kind of seen, uh, in really the best light, focusing on development. But now, as we fast forward and you look at the market and you look at kind of the lack of these critical kind of tier one assets, our ability to go out and secure these, well in advance, I think is going to give us a very significant kind of edge as we continue to grow our business. Beyond that, we recently put in place a credit facility with Bank of Montreal and National Bank Financials for a total of base and accordion of up to 75 million US. And so this was a critical tool that we've been looking to secure for the last year or so, and it's a very kind of traditional tool when you look at the royalty and streaming sector in general. But what it does, it allows you to kind of scale your business in kind of much larger transactions, because you can add kind of a reasonable or competitive cost of credit as another kind of part of what the transactions are worth, and that also allows you to grow in a more non-dilutive way than just kind of raising equity or other means to finance these acquisitions. So that was pretty key for our business. Beyond that, I think the macro tailwinds. I mean, you look at gold, we're two-thirds weighted towards gold and silver. Again, locking in exposure to these assets mainly between 12 and $1,800 gold. So when you think about a return on an asset at 12 to $1,800 gold, and then now it's finally in production today, some of the returns, some of the paybacks that we were expecting to get paid back once these assets started production over 4, 5, 6, 7 years, are now paying back in kind of 2, 3. So very, very significant returns on invested capital. And copper. I mean, copper, I think is just in an absolute incredible place from a supply and demand perspective as well. So I think all of this kind of together, Metalla has a long, long way to go. When you look at kind of the valuations across the industry, again, and this is kind of, you can make this general statement, companies kind of sub-billion to 200 million market cap, didn't really get the inflows for the first part of the bull market. So you've got great solid businesses, if you have time to roll up your sleeves and do your homework of, companies that are not, they're very, very kind of well, from a risk perspective, they're, I would say, not too dissimilar to some of the bigger companies, but, haven't been the beneficiary of some of these capital flows until now. And so, the difference in valuations is still kind of quite extreme. I think it's just kind of getting started for a lot of the high quality juniors.
I understand you don't want to be dilutive right now. No company does, but I'm just curious as to why a company like yours wouldn't want to take advantage of the much higher share price, as well as much higher metals prices right now, and issue some equity, maybe in the form of warrants, to take advantage of much higher valuations now. Is there a particular strategy around that?
No, our business is self-funded. We've got a number of years of EBITDA growth in front of us, as I noted before, at a rate of probably in the 30 to 35% CAGR through the end of this decade. So there's really no interest in raising equity, unless specifically it was kind of a piece of a larger asset. I think that there are still a pretty reasonable amount of opportunities within our business, and kind of where the opportunities that we're looking at, call it between 50 and 150 million. As we see the mid tiers get consolidated, which I think will continue, it'll be a bit of a vacuum, I think, up to the high end, and you're going to have this massive gap, probably the biggest gap that's like ever existed in the royalty business in history. And there's a handful, very, very small handful of juniors that are that have access in a reasonably competitive cost of capital and availability of credit to be able to scale into this and scale into being kind of a larger mid tier. So we're at this stage, aside from kind of a transactional And we have been very, very disciplined over 32 different acquisitions that we made over the last 8 years, to make sure that those are accretive on a per share basis. So we look to kind of use those same very disciplined approach to acquisitions, but just a lot bigger to allow us to kind of scale up. And I think be the beneficiary of a lot of this M&A that we see here happening today, and will likely continue.
What's next for acquiring new projects for you? Any jurisdictions you're eyeing, perhaps, and any details you can provide right now?
Well, we'll focus on the jurisdictions that we're in. So we want to keep the story very, very clean from a jurisdictional perspective, from an operator perspective. That's been the core part of our long-term vision since the very beginning, since inception of the business. So high quality operators, proven geological trends, and tier one jurisdictions. I think the difference between kind of what we've looked at in the past and kind of what we're looking at today is really just a function of the evolution of the business and the availability of the tools. Mainly the revolving credit facility that was recently put in place now allows us to look at transactions instead of kind of 5 to 10 million. We can look at transactions, in the 50, 150 plus range, and primarily those will likely be on assets that are either in production or very, very near production, as they would require, as credit would kind of require them to be so.
Okay. Has your budget for partnering with projects changed in the last year, ever since the price of gold and copper went up and your share price accordingly as well?
Yeah, I mean, look, it's been a difficult time to be able to put values on assets over the last year because there has been a significant move in the underlying commodity price. So if you look at kind of analyst consensus today, it's almost $1,000. The long-term analyst consensus gold price is almost $1,000 below spot. And so, when you look at that from a business like Metalla and kind of from a valuation perspective, it's it's difficult to use some of those higher metal prices, or maybe not difficult, but that there's a lot more risk that's involved with kind of making different assumptions with higher metal prices. And so when we have seen transactions that have gone up over the last year, I mean, typically when we kind of we're working through kind of what the winners of some of those transactions had to assume. Ultimately, like it was probably either a much higher metal price or some other assumptions that got them to a place to be able to kind of feel comfort. So when you see big moves in the underlying commodities, it's typically not a time where you want to be super aggressive. So if you look at Metalla as an example, we did 32 transactions over 8 years. I think we led the industry, big and small, on kind of a number of acquisitions completed. And over the last year and a half, we did none. And it wasn't that we couldn't do transactions, but we just didn't see really the value and really the risk kind of associated with making certain assumptions to be able to be successful was not ideal. But now we're seeing that start to balance out. We're seeing kind of the long-term trend, or the long-term analyst consensus gold price start to kind of creep up higher. And as that does, I think it's going to, and as gold kind of consolidates, which I think it also, will consolidate, it probably consolidates more in other currencies than the USD, just because as the USD depreciates, gold probably has a bit more of a modest increase. But as all that kind of settles out, it's going to create an environment where we can get a little bit more comfort to take, a bigger swing, again, maintaining the profile of very high quality, within jurisdiction and operator. But one of the benefits here, with the business that has a lot of organic growth already worked in, it's every single increase in that long-term gold price as the analysts are increasing that, which, started off this year kind of in the closer to 2000. By the end of this year, it'll probably be closer to 3000. But every $100 that's increased within the gold price, adds on the long-term gold price can add, upwards of 40 plus million US to our NAV. So when
Okay.
you think about like where long term and spot is $1,000 apart, you can kind of quickly see like, oh, what is the street thinking? And I think other investors are starting to kind of see that. And wait a second, like most of this gold is being valued at $2,500 within the long-term analyst consensus and not 3,000. And what impact does that have to the underlying NAV or value or intrinsic value of this business? And it's quite substantial. So it's something that I think investors are paying a bit more attention to.
All right, great. Where can we stay up to date with you and your work for now?
Yeah, you can go to our website, metalloroyalty.com. We actually recently just published our 2025 asset handbook. So that is a very great resource for investors to go on. You can download the handbook. It goes through specifically all of the different royalties that we have. You can see kind of the jurisdictional profile, the commodity profile, the production versus development versus exploration profile. It's got all that great data in there, and it's a very quick read to be able to understand the business and really the value. And I think what is going to be driving probably our share price a lot higher here over the next year or two.
Okay, great. Thank you. We'll put the links down below. Appreciate your time today, Brett, and we'll see you next time.
Thanks, David. Thanks for having me on.
Thank you for watching. Don't forget to like and subscribe.